Hello and welcome back. My name is Josh and this is Finance Soup. And today I wanted to go over something a little different. This is actually not going to be a stock, this is going to be an ETF. For those who don't know, an ETF is basically an investment vehicle that holds multiple stocks, and it's a great way to diversify. They always say you should diversify when you're owning stocks. So this is a great way to easily diversify. A lot of people, I actually think that if you're a beginner and you don't know a lot about stocks, but you're trying to dip your toes in, the best way is to buy an ETF. An ETF, again, it tracks a segment of the market. So there's the SPY ETF, which tracks the S&P 500, basically owns all the companies in the S&P 500. There's ARK, Kathy Wood's ARK, commonly known ETF. They invest in a whole bunch of what companies in innovation. That's their niche. There's thematic ETFs. So if you said, hey, I only want to buy XHB, that's one that only owns home building companies. So it owns home building companies and companies that do ACs and everything related to the home building. So if you have a thesis that says, I think home building is going to improve, you could buy it XHB. I'm sure there's one for airlines. Let's look, Airline ETF. The best and only airline ETF. I'm sure there's one. Here you go. It's called Jets. And so, again, it's a great way to invest in a segment of the market with lower volatility. Again, betting on a single stock can have a lot of volatility. If you invest in Verizon versus AT&T, they're both telecom companies, but they've gone in completely different directions over the last 10 years, right? Let's look at Verizon, T stock. If we look here, we can see in the last 5 years, it's mostly flat, down 2% maybe. While AT&T, there is also a dividend, 5% dividend, while AT&T stock over the last 5 years is down 40%, right? So if you had a thesis on telecom, you might have been wrong, but it would have been better to invest in an ETF that holds all of them rather than just buying a one. So it's typically going to lead to lower, if instead of the market going, if a stock like Tesla goes up 50%, the ETF that holds a bunch of electric vehicle companies might only go up 20 or 30%. But if something goes down, you're also going down less. So it's a good way to diversify. I'm a big fan of ETFs, especially for beginner investors, because you don't have to do your own research as much. You can research a segment of the market without actually doing research into individual companies, which can be tedious and take some more technical skills. So again, I'm a big fan of ETFs. There's a couple things you always got to look at when there's an ETF. The biggest one is the expense ratio. The expense ratio is how much they charge you for this ETF. Again, for them doing the service of buying and selling stocks as they see fit, they're going to take an expense ratio. Some have very high expense ratios, close to 1%. With most ETFs, I like to look for very low expense ratios. So again, I would say typically the more generic an ETF, like an S&P 500 one or a Bitcoin ETF, I think that's going to see lower ones as more Bitcoin ETFs get into the market, because what's the difference between one Bitcoin ETF and another? Very little, so that will drive prices down. If you have a very unique ETF, like the ARK ETF, ARK expense ratio, you can see here ARK has 0.75, so it's literally 10 times higher than this ETF. So, but they're doing a lot more work, right? ARK is doing lots of research and actively managing this portfolio of innovative companies. So it might be worth it, but you always want to look at the expense ratio. So today I want to discuss this one called MGK. That's the Vanguard Mega Cap Growth Index. Huge fan of this. So first off, this is not investment advice. This is just my opinion. But I'm a shareholder in this company and have been for a while. And if we zoom out, again, past performance is not indicative of future performance, but it's seen very strong growth over the last 23 years, up 800%. Now we look at the S&P 500. Actually, let's do SPY ETF. So that is ticker. Oops. There we go. So this is the SPY ETF. And when we look over since 2008, where was that? Let's go here. This is up 400%, so only half the rate. So one, again, back test, previous results aren't indicative of future results, but it's had a very good history. It's done extraordinarily well over the last year. It's up 33%. So what is in this one? So again, it's Mega Cap Growth ETF. So if you actually look here, you can see seeks to track the performance of the Mega Cap Growth Index, employs a passive management, and provides a way to get diversified exposure to the largest growth stocks in the US. So while the S&P 500 owns 500 companies, when you look at it, the top companies there, the Apples, the Googles, the Facebooks, the Teslas, the biggest companies have accounted for the vast majority of the growth. If you look at Apple alone, it's grown in the last 5 years, it's up 400%. So in the last 5 years, it's beating the entire S&P 500 over the last 13 years. So these big, huge companies have seen much faster growth than the bottom companies in the S&P 500. So the way I like to look at MGK is I think of it as the S&P 100. It's basically the 100 largest companies in the S&P 500. And the thesis is these big companies because of network effects with software and the way that the world is moving, how, when you are a car manufacturer, if you need to grow, you probably need to keep building factories, which means lots of CapEx. It's very hard to grow. It's very capital intensive, very expensive. With software, you can scale much quicker. And as you get to scale, it's much harder for people to switch. People don't, there's Bing, there's other search engines, but still people use Google because when they're at this scale, they can use their scale to their advantage by they have more data, which means they can optimize more, all this. So this whole theory of mine is that the largest companies are going to benefit disproportionately over the bottom 400 companies in the S&P 500, which still might do well, but won't do as well. So this is really to be picking the best of the best out of the S&P 500. And when you look at it, we see here percentage of fund. We can see it's Amazon, Facebook, Apple, Alphabet, Tesla, Apple. That's weird. I guess it's not actually doing it as a number, it's doing it as a text, but Apple, Microsoft, Home Depot. You can see it starts going down to quite a low percentage, but there's 106 holdings here. So it's not exactly the top 100, but it's basically the top 100 companies. And these companies have shown, as you can see, based on its comparison versus the S&P 500 ETF, it's grown basically twice as quickly. And I continue to believe in this thesis. So if you're looking for an investment that's going to be passive, you don't have to actively manage it. You don't have to check, what's the earnings call? What's this? That's going to be well diversified. To me, this is my recommendation for a go-to investment that should be a core part of your position. Not saying it has to be the only part. I don't believe in that. I don't believe you should be all ETFs. But if you're starting out, it's a great starter position. And if you are, I personally implement what's called a barbell strategy. Basically means I try to do 80% safer investments, so these blue chip stocks, and then 20% riskier things. It hasn't worked out that way because Tesla and Bitcoin have gone up so much that originally they were about 20% and now it's worth a lot more than that. But my invested capital was 80-20. You want to protect this, and a stock like this is much less likely to be hit substantially compared to a single stock, which again is less diversified, so it's more open to risk should there be a change in the political environment or new competitors enter. This is managed also, so if there are changes, they will, if suddenly a company starts growing quickly. I think Tesla's in here now. It wasn't originally, because originally it wasn't a mega cap. So you won't get 100% of the growth if you bet on a stock that turns out to be right, but you also won't have as much risk. So I'm a big believer in this one. Again, it's ticker MGK. Hopefully this was informative. I am a shareholder and I'm going to continue to buy. I try to buy a little every month of MGK dollar cost averaging. So let me know your thoughts. If you have any suggestions for stocks I could recommend or want me to analyze, let me know in the comment section below. Thanks so much and talk to you next time. Cheers.